Good afternoon, everybody. I just want to welcome everybody to our first Navigation Today's Affordability Housing Virtual Series. That is a mouthful. As I refer to it, is our virtual Zoom Lunch and Learn. And what we have done here with the Regional Housing Partnership, which I chair, is an advisory board to the Planning District Commission, the Thomas Jefferson Planning District Commission. And what our goal here on the Regional Housing Partnership, frankly, is to attack housing from a regional perspective. And we bring all the nonprofits, the for-profits on it, public service folks or the public Board of Supervisors, city councilors, and we actually have UVA part of it, which is super exciting that they're part of this discussion. So the purpose of it is really to drive diversity of what I'm passionate about is affordable housing, and what the good doctor is going to talk about here in a little bit is how the real estate market is currently impacted by COVID-19. I'm going to skip here in a little bit and let the president of CAR, Tom Wohlforth, do the introduction of Lisa. But I have to tell you, before I do that, I'll take a little bit of thunder at the little chairman's prerogative on this. When you think economists, you don't necessarily think rock stars. You need to think rock stars when you listen to Lisa, because that's exactly what she is. So Tom, take it away. It's on you, brother.
Hello, everyone, and Keith, thank you. As he mentioned, I'm Tom Wohlforth, and this year I'm president of the Charlottesville Area Association of Realtors, or CAR, as we like to call ourselves. Looking at how important this topic of affordable housing is, we're very honored to sponsor this series, and also to be invited to the conversation, because we're looking for innovative ways to address this problem. It's not going to be solved overnight, but with concerted effort, we're very happy to be part of it. We're widely recognized as the leading voice for real estate in Central Virginia, have been since 1925, and we advocate for the protection of private property rights. CAR also provides tools and technologies for our members to achieve expertise in serving the needs of our customers and clients. I'm also pleased to share that we partner with Dr. Lisa Sturdivant, who Keith mentioned, on our quarterly market reports. That's an awesome report, and they are available to the public, and so to everybody here. You can download this for free off our website at caar.com, and also on our social media channels. So take a look at Facebook for that. So if you have any questions about today's market, this is just my broad general BR statement here, but if you have any questions about the market, what's going on, and there's a lot that Dr. Sturdivant will address for us, but contact a realtor. That's what we're here for, is to help you. We've got the expertise, we've got the tools, and since we work locally, we have that local insight that you need to make the very best real estate decision. So having given my plug, Keith, I'm going to hand it back to you.
Thank you, Tom. So thank you, Ali, who just PM'd me. I'm supposed to introduce the good doctor, so that falls upon me. So thank you, Tom, for doing it, and thank you for sponsoring this. It's a great asset. So I'm going to stay on script, Lisa, if you don't mind. So thank you again, Tom. So Dr. Sturver, maybe I won't stay on script. So there you go. This is what you get, guys. I said earlier, she's a rock star. And when one thinks of economists, you don't kind of think of that. And in every conversation I've ever been involved in, either virtually or in person, one thinks you understand this market, and one thinks, particularly in our line of work, that you think you understand this, and you listen to the good doctor, and then you go, oh my God, I didn't look at it from that perspective. So that's what she's going to bring today in our presentation. Her accolades, her list of PhDs, and all this fun stuff is super long. Get on Google, check her out. She also does this awesome Facebook Live thing for those out there that want to look at it every Friday. It competes with another show, but we'll let you watch that one. So I think that's where we're at with this agenda. So Doc, it's all you, buddy.
I've stopped sharing my screen, so we'll pull up yours if you're ready.
I don't even know what to say to that introduction other than thank you. And but honestly, very, very pleased to be here today to start the conversation for this series around housing affordability in the Charlottesville area. As Keith mentioned, and as Tom mentioned, I do a lot of work looking at data and thinking about the housing market and the economy. Housing affordability is an issue that I've been involved with for a really long time and feel really passionate about, and really welcome any opportunity to work with those of you who are interested in this issue, making sure that the issue remains front of mind and thinking about strategies for making sure that all of us have access to affordable, safe, decent, quality housing. So I'm going to spend a little bit of time today just laying some groundwork that hopefully will help with the subsequent conversations I know you all are going to have over the coming weeks. I'm going to talk a little bit about where we are in the economy, where we are in the housing market in both Virginia as well as in the Charlottesville area. I'm going to focus primarily on the for sale side of the market, not because the rental side's not important, but because I have a lot more current data on the for sale side. It gives us a good picture into what's going on in the real estate market, and hopefully we'll have some time for questions where we can sort of probe a little bit more on the rental side. First, I want to talk about a few key trends that are affecting the housing market here in Virginia, and frankly, all of us who are working in the real estate industry. The first, as everyone knows, we've gone through a really dramatic downturn in the economy, and we are now in sort of a period of recovery. And we've heard all sorts of different letters for how the recovery might happen, a V shape, a W shape, an L shape. And the latest letter is K. And this K-shaped recovery is one way to think about how some people are benefiting in this recovery more than others. So for some, the downturn hasn't been as big of an impact. And for some, the recovery is happening very strongly this fall. Homeowners have been better positioned, for example, than renters in this economic downturn. For some, the recovery hasn't touched their lives yet and will continue to face challenges in the weeks and months to come. And that's really important when we talk about recovery and what it means for individuals and families in the housing market. It's not affecting all of us the same way. The other key factor has to do with interest rates. We know mortgage rates have been very low, and all signs from the Federal Reserve are that rates will remain low well into 2021, which has, again, benefited some segment of our population, including our homeowners and our would-be home buyers. Less of an impact in many ways on other folks. Home sales activity rebounded really strongly, but we're going to talk a little bit, and we're going to talk a little bit about what that means for affordability and for availability. And then finally, we'll talk a little bit about what this might, what COVID might mean for longer-term trends in housing preferences and demand. So let's look at the economy first. This is a picture of job growth since 2016, and up until 2020, this is a pretty boring graph. Job growth tends to be pretty steady month to month. We lost 22 million jobs in the United States, but we have seen 4 consecutive months of job growth nationally. We are expecting that the unemployment rate will hit 8% by the end of the year, which is much higher than it has been in typical years, but is much better than the unemployment rate we were seeing back in the spring, which is a good sign people are returning to the labor market. Here in Virginia, we're actually a little bit ahead of the nation in terms of our overall economic recovery. We've also seen job growth up for 4 consecutive months. In August, the unemployment rate was 6.1%. Which again is much lower than we had seen earlier in the spring, reflecting improvement in the labor market. But keep in mind, last year at this time, the unemployment rate was about 3%. So we still have folks who are facing unemployment and job loss. And we also have folks who are leaving the labor force altogether as a result of the coronavirus. When we look at the job gains, we tend to look at which sectors added jobs month to month. August is a little bit of a strange month in some ways. We saw the biggest gains in Virginia in jobs were in local government, A lot of that was ramp up for the start of the school year, where school districts have hired on school year 9-month staff in August. Big gains also in leisure and hospitality and retail trade, which are two of the sectors that have been hardest hit by the economic downturn. We get to see unemployment data every Thursday, and so data are current as of yesterday, the 24th, and the dashed line shows the number of people each week who applied for unemployment benefits. And you can see that really peaked back in late March and early April at the beginning of the pandemic and because of the government shutdown. And you can see that that's tailed off over time. The solid line is a picture of how many Virginia residents are still receiving unemployment benefits at any given week. And in mid-September, about 186,000 Virginians were receiving unemployment, which is well below where we were this spring, but well above where a typical economy would be. So we still have some good news in terms of the economic recovery here in Virginia, but we still have a long way to go. Let's take a quick look at Charlottesville. We have data through July showing that in the region, similar to in the state, about half of the jobs that were lost this spring have been added back. The unemployment rate is a little bit higher than the statewide rate in July. We don't have August data yet. And we anticipate that that rate will also be low as the economy in the region begins to strengthen here as we head into the fall. Unemployment has also fallen in the Charlottesville area, although it does remain elevated relative to where we would be in a typical environment. We talk a lot about this economic data, and a lot of the economic data overall are fairly positive or moving in the right direction. But there's this other indicator, which I find almost as interesting, if not more interesting, which has to do with consumer confidence. And these data are based on a survey where people are asked, not did you have a job last week or not are you unemployed, but rather how do you feel about the economy? And how people feel about the economy is really important when it comes to making big decisions like starting a new job or opening a business or buying a home. Consumer confidence had been bumping around here, but really plummeted in August as people became a little less certain as federal pandemic assistance ended, as expanded unemployment benefits came to an end, as coronavirus cases increased in some parts of the country. And so this is a testament to the fact that while the economy is recovering, there's still a lot of uncertainty in the economic data and a lot of uncertainty in people's feelings about the economy. And that will probably be true throughout the rest of 2020 and into 2021, and perhaps even until there is a coronavirus vaccine that is widely available. And so we're looking at a long-term recovery from this pretty dramatic public health related economic downturn that we've been in. We talk all about that for lots of reasons, but the state of the economy has a really important impact on the housing market in many different ways. But it turns out that the housing market has recovered a lot more quickly than the overall economy. And we have to keep that in mind, right? The economy and the housing market are different things. And this is US data, but it shows very clearly this V-shaped recovery in the housing market. There are a number of reasons why the housing market has been so resilient. And this gets a little bit to this K-shaped recovery. I'm throwing a lot of letters out today. I'm not sure that's a good thing necessarily, but it has to do a little bit with the shape of the overall recovery. Job losses, which have been dramatic, have though been very concentrated in a handful of industries. Accommodation and food services, restaurant, retail, bars, hotels, retail trade, very concentrated job losses. And folks in those sectors tend to be more likely to be renters. A lot of other industries, a lot of other sectors have seen work be able to shift from the office to home. Many of us have moved our work home, so we're telecommuting. And some of those sectors like professional services and finance and government that have shifted to working from home tend to be more in the home buying population. And so, and in fact, for many of those folks, their financial situations have improved during coronavirus. saving more because there's fewer costs of going to work, maybe saving on childcare. And so the ways in which workers have been impacted by the downturn has really had an effect on the housing market. And folks who are still in the housing market, the for sale market, many have been relatively insulated from the economic distress that the recession has caused. Mortgage rates have been at historically low levels. As of yesterday, the 30-year fixed rate mortgage rate has been below 3% on average for 9 consecutive weeks. And that has made both home purchasing and refinancing very attractive. And then lastly, we know that going into the housing market, demand was really strong, largely driven by the large millennial population that has moved into prime home buying ages. And that demand is still there as people have been able to get back into the market. So let's take a little bit of what we're seeing here in the market. The top charts are going to be the Virginia data. The bottom charts are going to be the Charlottesville area. These are monthly home sales. And if you ever wondered if the housing market was cyclical or seasonal, this is pretty clear that home sales tend to rise in the summer and tend to be lower in the winter. And but at the end of the day, we can see that statewide August home sale numbers were up strongly compared to a year ago, continuing a positive trend in June and July after a pretty dramatic downturn in April and May. Home sales were up 10.6% in August. In the Charlottesville area, home sales were also up in August, up by a little bit less than 1%, down from July. And so this slight slowdown in home sales activity, I'll come back to this, but is been more strongly driven by a lack of supply rather than any sort of dampening of demand in the area market, the regional market. And we'll come back to that issue in just a minute. But what we do know is that we saw such a slowdown this spring as the stay-at-home directive was put in place and public health concerns were really at their height. And we did see this movement of spring home sales shifting into the summer. So we saw the spring market down by about 10% statewide compared to a year ago. But in the summer, we've seen sales up by about 6.5%. And we expect that to be true moving into September as well. So again, that's a testament to the fact that demand was there before COVID. It took a pause when people were figuring out the new restrictions, were taking care to take care of themselves and their families. And we've seen a return on the part of many buyers this summer. Inventory, though, supply remains the major constraint, and COVID has exacerbated what was already a tight housing market in just about every regional housing market across Virginia. In August, the number of available homes listed for sale in Virginia statewide was down by more than 40%. So compared to a year ago, there were 40% fewer homes available to purchase in August compared to what there was a year ago, even as demand has been strong. We've seen similar trends in the Charlottesville area where inventory has been on the decline really for 5 or 6 straight years. And in August, the number of active listings at the end of the month was down by about 43% compared to a year ago. Well, so some sellers have returned to some markets. Now, there's a lot of charts on this page, but what I wanted to highlight was we know that buyer activity has returned. In some markets, sellers have also returned. So we've seen an increase in new listings, monthly new listings in some markets. For example, in Nelson County in August, the number of new listings coming to market was up 16%. In Louisa County, the number of new listings was up by 50% compared to a year ago. But there are still places where inventory is still quite low, where people are not listing their homes, where new construction hasn't ramped up sufficiently to meet demand. And these inventory constraints are going to have a major, major impact on affordability and making it harder for first-time home buyers and others to access the housing market. And we'll talk more about that in just a bit. Is another way to think about it. Every month there's homes that are sold and homes that go under contract. Every month there are homes that are listed for sale. And the gap between the homes that are sold and the homes that are listed is growing. So basically there in August, there were 406 more homes sold than there were then came on the market in the Charlottesville area. And you can see over the last 8 months that that gap has really increased over time. And this creates a really challenging affordability environment for potential home buyers. We have a little bit of data about what the fall might look like. Pending sales data are homes that went under contract in the month but hadn't closed by the end of the month. Pending sales up by 16% in August, which means that next month those closed sales numbers will be higher as well. Pending sales really surged in the Charlottesville area in August, again, drawing down that very limited inventory as home buyers return to the market. We talked about being an economist. You don't have to be an economist to know that when demand is up and supply is down, we know that the price of something increases. And that is certainly what we've been seeing here statewide. The median sales price in August was $330,000, which was up 10.4% from a year ago. Strong demand, low supply, very favorable mortgage rates have all contributed to the steady increase in home prices across really all markets across the state. And we can see that as well in the Charlottesville area where home prices are up by double digits in nearly every local market. You'll notice I've kept the scale on each of these charts the same, just to demonstrate that, for example, while home prices are relatively low in, say, Louisa County, you can see that there have been double-digit price growth in that county, even as prices have been up even more strongly in Albemarle County, in Greene County. Upward home pressure on home prices continues across the Charlottesville area, and really at a faster rate than we are seeing in some other markets. Prices are up in Richmond, prices are up in Hampton Roads, prices are up in the Winchester area, but we're really seeing extra pressure on home prices in Charlottesville because of the very low inventory and the rising demand. Demand is strong across price points, but I thought it was interesting to try and break out the market a little bit. This is a bit of a weird slide, but entry-level homes, what I'm calling entry-level, priced below $300,000, make up about 42% of August sales. There's only about 1.4 months of supply. That's what that MOS is. And so very, very limited available inventory of these entry-level starter homes, more affordable price points. When you look at mid-level homes, sort of through 300 to 600,000, about 45% of the market, a little bit more inventory, 2.8 months of supply. And then you can see going to the higher end that inventory remains a little bit higher, takes a little bit longer to sell homes. That average days on market is what that DOM stands for. And the average S to L ratio is sales to list ratio. So you can see, for example, in the mid-level price, the average sales to list ratio is over 99%, which means people are listing their homes and they're getting, they're getting what they're asking, a little bit lower in some cases. And nearly all Virginia realtors that we surveyed are seeing multiple offers, and the biggest competition has been in that entry-level segment of the market, as well as the mid-level homes. 9 out of 10, more than 9 out of 10 realtors say that they're seeing multiple offers on their transactions over the last month. And so these bidding wars are occurring. One of the main reasons that we're seeing such buyer interest is that there are buyers who, like I said, are in pretty good financial situations, haven't been hit as hard by the downturn, and they're looking to purchase because that is their goal. And they're looking to take advantage of historically low interest rates. The data from yesterday would change this slide to say below 3% for 9 consecutive weeks, making purchasing a home much more attractive. I will say there is a little bit of a downside to these low rates because it's also making refinancing a mortgage very attractive as well. So what we're finding is that the number of refinance applications is actually surging and is increasing more quickly than purchase applications. And as people refinance their mortgage, chances are they're going to stay put for a while. They're going to use some of that freed up cash to make renovations to their home or to fix up their home and to stay in their home as opposed to listing it for sale. And so these low rates could actually exacerbate the inventory challenge even further in the months to come. I've often gotten questions about, whether we should be worried about foreclosure activity. Many people remember the last recession where foreclosures were a huge impact on the housing market, impacting millions of individuals and families across the country and throughout Virginia. Because of some of the steps the government took on banning foreclosures and establishing forbearance programs for mortgage holders, so far, foreclosure activity has been very, very low, in fact, lower than in past years at this point. There is some concern that we might see a bump in foreclosure activity when forbearance periods end, when people are finding they have to make those past payments that they were able to delay and find themselves unable to do so. We've seen the delinquency rate rise in recent months a little bit. So we expect that foreclosures may increase somewhat in the months to come, but nowhere near, we're not talking anywhere near what we saw back in 2008, and won't be won't help on the inventory side and won't have a major impact on prices, certainly. Just want to end just with talking about, I focused a lot on homeownership. I mentioned that at the outset. There is obviously a broader real estate market, and the rental side of the market is also really key. One reason we talk about homeownership is really about wealth creation. And we know for most of us, homeownership is the primary way by which household wealth is accumulated. The homeownership rate in Virginia has declined since 2005, but it has been on the rise, and it is above where the US rate is. So 67% of Virginia households are homeowners. The bottom was back in 2016. But homeownership hasn't accrued to all Virginians equally. The homeownership rate among African-American households in Virginia was 47.7% in 2018, the latest data that I have this broken out by race. And you can see some of the gaps between white homeownership and homeownership rates among African-American and Hispanic households in Virginia. One thing that's really important to remember is I talked about the benefits of homeownership for wealth accumulation, but for many Virginians, that hasn't been a possibility. And the concern is that COVID is making that challenge even greater. The homeownership rate for African Americans in Virginia now is below where it was in 1968 when the Fair Housing Act was passed. And so that means that there is sort of a long legacy of a segment of our population that has been less able to achieve wealth creation through homeownership over the last few decades. And again, as COVID sort of shapes this K-shaped recovery, the concern is that folks who have been left out before may be even further left out as we recover. We know from national data that African Americans are less likely to ever own a home, are more likely to buy a home later in life, therefore having less chance to accumulate wealth, buy less expensive homes but have higher mortgage debt, and tend to have higher interest costs on their home loan. And we know one of the results of that is having lower housing wealth and having, frankly, less net worth overall over time. And so this idea of expanding home ownership ends up being pretty important for wealth creation. The gap between median family wealth of white households and African-American households nationwide has grown since the mid-1980s. And one of the primary reasons has been this disparity in access to home ownership. So I know y'all are going to spend the next few weeks talking about this challenge of affordability and where some solutions might be, and where you as a region can be part of that solution. And we know that, increasing supply has got to be part of the conversation. Reviewing how mortgage lending requirements and credit scoring is sort of used to determine loan eligibility is important. And frankly, all of us actively promoting fair housing in all of our regions across the state. So as we sort of do an outlook here, what's ahead for 2020 and 2021, and then I'm going to turn it back over to Keith, and hopefully we'll have time for some questions, a little bit of conversation. We do see this V-shaped housing market recovery. The housing market on the for sale side has really been leading us out of the downturn. We have data on US new home sales for August, and they surged, beating expectations. The broader economy is recovering a little bit differently and much more slowly in some ways. The jobs we lost in the spring, it will likely take months, perhaps years, to recover those jobs that were lost. Some are benefiting in this recovery. However, some are falling behind, and COVID has brought to light some of the inequalities that existed in society and in the economy, brought those to light in a way that we hadn't seen as obviously before. And there's a risk that those inequalities may widen as the recovery continues. The demand for homeownership in Virginia and in the Charlottesville area will remain very strong. Part of that will be driven by low mortgage rates, which will make home buying less expensive on one side, but will also may have the result of reducing supply, which will put upward pressure on home prices in the months to come. One of the things that I think we're starting to see, and we know in the summer data, we saw that home sales activity was stronger in Virginia's smaller markets, in the rural and suburban markets, compared to the state's urban markets. And so there's a sense that there may be more demand for smaller markets as people continue to work from home, as employers look to make work from home arrangements more permanent. Some individuals and families are saying, well, heck, I don't need to live in downtown Richmond or near downtown Richmond. I don't need to live in Fairfax County. I don't need to live in some of these higher cost urban areas. Maybe for quality of life purposes, we can move to some smaller community in Virginia since I can do my work from home. Access to high-speed internet will be critical to those markets that attract those kinds of households. And Charlottesville certainly has always been a market that folks have looked to as a place for high quality of life. And I anticipate that demand for housing in the Charlottesville area from places like Northern Virginia, from places like DC, will be on the rise in the months to come. Again, putting more competition out there for homes on the for sale side and the rental side, pushing up prices. So housing affordability will remain a challenge in the Charlottesville area. And so this effort that the region is taking to come together to continue this conversation about housing affordability, which we sort of maybe pressed pause on a little bit when we were dealing with COVID, it's kind of more timely than ever to ensure that as we think about the recovery, that all Virginians, all Charlottesville area residents have access to high quality housing that they can afford so that individuals and families across the Commonwealth can thrive. So I'm going to end there. I will stop sharing my screen and turn it back over to Keith and to Tom, and would love to hear if there are questions or comments or any other information that you think is important for us to sort of put out there as we begin to lay the groundwork for this series of conversations around housing affordability.
Lisa, thank you very much. When I said you were a rock star, I meant it. I literally got 7 pages of notes here. I will refrain from asking questions. So everybody, I sent out a feed in the chat. Plug in your questions in there. If you would like me not to use your name, please note that in there. Otherwise, I will say who the question came from. I have one, but I'm going to save it for the back end of it. It probably will get answered in the feed. So this is coming from Chip. What do you think about the inventory relationship to urban and rural? Anywhere you would like to go with that?
Yeah, so I think this overall question about why inventory is so low is a really good one. And I think it actually allows me to have the chance to say something I like to say a lot is we talk so much about what's happening to the market as a result of COVID and the economic downturn, but there were longer term trends going on before COVID hit. And this declining inventory is one of them. One reason why inventory has remained low is a demographic explanation. And I've dug into the numbers a little bit on this. So I feel convinced that this is at least part of the story. Our population, as you all know, every day, whether we want to or not, we're all getting older. And we have a larger share of households that are in their 50s and 60s. And that larger share, when you look at the data, are remaining in their homes longer. They're holding on to those homes longer. So you have more people in that age group that tend to be in their homes longer, and that group itself is staying longer. And so as people are remaining in their homes longer, it means that there's less churn in the market and less inventory being made available. Why are people staying in their homes longer? Well, I think there's a few reasons. Sometimes it's by choice. I'm not sure if you've heard, but we had a lot of kind of millennials coming back to live at home, and that trend of younger folks coming back to live with parents is actually increased during COVID. And there's some folks who said, I'm going to keep the big home because I'm not sure when I'm going to want my family to be living back with me. So there's a cultural and a preference reason why people are living in their homes longer. And then there's also a supply issue, kind of like reinforces each other, because new construction has been below what's needed to meet demand. Some folks find that even if they wanted to move out of a bigger home into something smaller, that housing is not available. So that's a little bit of a longer answer than you probably wanted, but it helps us to keep in mind that there's this underlying demographic trend that's going on that has just been exacerbated by COVID.
Well, Lisa, I think that needed the time to explain that. So thank you very much for doing that. And the next question, and I'm going to change it a little bit and shorten it a little bit, but you mentioned earlier that loan qualifications are becoming a little bit more restrictive. And I'll add a little bit of to that particular question. The underwriters are becoming a little bit more restrictive on that. So would you like to talk about that a little bit, particularly how it would impact the affordability index that we've been talking about, that you've been talking about?
Yeah, so I think that there is, everyone sees the low mortgage rates, and that seems like that is good news for folks looking to buy a home. But what we're finding is that the criteria for qualifying for mortgages has tightened up during coronavirus, where lenders are looking for higher credit scores, as you say, Keith. The underwriters are looking for lower, debt to income ratios. We're also seeing that there is a lot more scrutiny over employment status. So in the past, you may have, gotten your employment status confirmed once during the mortgage application process, but now because everything is so uncertain in the economy, there is a check back, multiple times, sometimes during the application process. We also know that many people, this is one of the things that COVID has sort of highlighted. There are lots of folks who are working in the gig economy and the independent contractor economy. And in the past, that would have been something a mortgage lender would, be able to help work through in the mortgage application process. But in this current economic environment, working in the gig economy, working as a 1099 contractor raises more uncertainty. And so that leaves more people in a challenging situation to be able to secure a mortgage. And then the last thing I'll say, and this has been an issue that's been ongoing and is certainly not specific to coronavirus, but we do know that there are different ways that one could potentially measure a household's credit worthiness. And using FICO scores is the typical way that process is run when you're applying for a mortgage. And we know that process has disproportionately left otherwise qualified African-American and Hispanic households out of the mortgage market simply because they have thin credit files, or they're not able to use things like utility and other regular payments to establish credit. And so all of those issues combined have made it challenging for some folks to access these very favorable mortgage rates, even as many have been able to get it into the mortgage market.
So I'm going to pivot that question a little bit and refocus it on rental.
Okay.
Right. So we've been talking about the purchase side of the house, but on the rental side of the house, some of these same restrictions are impacting that. And then as a follow-up to that question, or a second portion of that question, give us your opinion, or where do you see this eviction process going? There's a lot of talk about that out there in the marketplace. But first off, how are these restrictions impacting rentals? We're starting to, at least I'm hearing it from my perspective on the street. And then what about evictions?
Yeah, Keith, I think that's a great question. And I think that some of the same factors are at play. Landlords and property managers who, of course, count on rental income to maintain their properties are taking a very close look at the economic situations of their applicants, making sure that they can be sure that rent payments will be able to come in. There is growing concern that renters are facing challenges in making those rent payments. According to data from the Census Bureau here in Virginia, about 1/3 of renters in August say they're worried about being able to make their September rent payment. And one of the solutions that has been talked about has been this, as you mentioned, this eviction moratorium, thinking, well, we don't want people unhoused. We don't want people who are facing economic hardship to be unhoused. However, at the same time, there is realization that property owners and landlords can't forego rent indefinitely because there is mortgages to be paid, utilities to be paid, insurance to be paid. The governor here in Virginia authorized the rent and mortgage relief program earlier this summer. A total of $50 million can be made available to renters who are having trouble making rent payments because of job or income loss. Just yesterday announced that that program's been expanded, and I know there in the Charlottesville area, regional nonprofits are working to help renters connect with that funding and their landlords to connect with that funding so that folks can stay in their homes and so that the rental market can stay liquid, frankly, over the coming months.
So a couple of questions came up in the feed, particularly about foreclosures.
Yeah.
You and I have had some discussions online and offline about this and the impact on the market. Personally, I come from a very different place because I survived the 2008 crisis where foreclosures were, just blowing through the roof. The use, we're going to get a little bit off of the rental side, back onto the purchase side of this ledger, but I know you talked about, you hit it in your talk a little bit, but can you just expand a little bit on why you think or you do not think foreclosures are going to be an issue in the future? Does that make sense?
Yeah, so I think that's a good question. And I think that we are likely to see the number of foreclosures in Virginia and nationwide increase over the coming months. There are so many reasons to make me feel confident that the extent of the foreclosure activity will in no way reflect what we saw in 2006 and 2007. So first on the why it will increase, we've seen about 7% of mortgages nationwide enter into forbearance programs. At the end of those forbearance periods, homeowners, mortgage holders are responsible for making those payments. And so at some point you have to pay the piper, as it was. And for some whose economic situations may not have stabilized, they may find themselves facing those delinquencies and foreclosure prospects again. So we do expect there to be some folks who are facing foreclosure. We've already seen that a little bit in the delinquency data. Overall, though, kind of at the macro level, one of the key drivers of the foreclosure crisis back in 2006 and 2007 was really an oversupply of housing and a very loose mortgage market that set people up in mortgage products that were basically designed to create sort of financial peril at some point during the term. And we don't have that oversupply challenge. We have a very different mortgage market. And while there is some evidence that there are some of those subprime mortgage products, of course, still in the market that could be at risk this time around, the numbers are just very different this time. And while, again, the individuals and families who face foreclosure, for them, it is a very challenging situation. For the market overall, it's very different than what we saw back the last time around.
So I'm looking at a chart put out by the U.S. foreclosure activity. 2009, it was over 350,000. And we are currently at, according to this chart, around 75,000. That's nationwide. So it's going to take a lot to get there. But I personally agree with you. I think the structural integrity of the system is nowhere back where it was in 2008. I often say, my 15-year-old dog could have got a loan back in 2008. There's a couple of questions coming in about sharing the slides. You're willing to share the slides, whatever. Thank you so much. So we've got about 10 minutes left. I'm trying to go through to see if we got any other I've got a question from Tom. How was the current pandemic and housing affordability issue impacting zoning reform? That's a
Yeah.
great question.
Yeah, and I think it really gets to the heart of what of when we start talking about solutions on the supply side for the housing affordability challenge. Um, I worked for local government for a while, and we can talk about all we want about policies at the federal level or even the state level, but at the end of the day, decisions about where and how much housing gets built takes place right on a Tuesday night in front of a zoning commission in local counties and cities across Virginia. Zoning reform is critical to expanding the diversity of housing options and the amount of housing available. I think that there is going to be, renewed discussion. Maybe zoning sort of took a pause as we sort of were, as local governments were dealing, frankly, with lots of other things over the last few months. But the numbers are clear that housing affordability is only going to become more challenging as people are looking, frankly, to move. And I know there was another question about this, as people may be looking to move to smaller communities or suburban communities. I think we're going to be having those conversations maybe in jurisdictions where they haven't been front of mind, right? Those suburban communities maybe where single family zoning has dominated and where the discussion may start to evolve to think about how can zoning be used to create a little bit more diversity and more options when it comes to housing, because that's the only way really to expand available housing and affordable housing.
Thank you for tackling that question, because that was going to be my next question. But I think the market trends that you shared with us, it's showing, when you start seeing Nelson County and some of these other outlying or rural counties, sales volume go up the way it is, it in my opinion, is a direct reflect of COVID. We're hearing that, from a practitioner's perspective, on a regular basis, to include the rental component too.
Yeah.
They want to have a little bit of distance. Zoom rooms or being able to do distance learning at home is a big question. So I'm trying to, do you see anything else in the feed there?
And Keith, as you're looking, just to kind of pick up on that, we don't have, I don't have the data in front of me for Virginia, but we do know from the National Association of Home Builders that multifamily construction is up. Single family construction's up a little bit faster, but multifamily construction is up pretty significantly in the suburban counties across the country and in the rural counties across the country, accelerating at a faster rate than in the urban counties, suggesting that, as you say, people may want a single family home ownership in the suburbs, but there's also a rising demand for rental housing in our suburban communities.
So we've have around 30 folks watching, and that's exciting. Any other questions that anybody? Oh, I see a new message come in, because I'm going to ask a question at the back end that might be a little bit difficult to answer, but I get it asked all the time. The question is coming in with the long-term impact from COVID and working at home. I think we've kind of had that conversation, but if you want to tackle that for a second, that would be great.
I do think we are seeing some movement on the margins of working from home and how that might be a situation that some families take on a permanent basis. I will say very clearly, though, I think the jury's still out. I think the talk about how office space is going to collapse and employers are going to decide they don't need office space anymore. There's a lot of evidence and some survey data that people are really eager to get back into an office environment. And so the office is not dead. People will return to working from an office environment. And I think the types of spaces might look a little different. Working from home will work for some segment of the population, but I feel like maybe the death of the office building is a little bit overstated.
So one just popped in, multifamily rental project having any difficult getting financing this day?
That's a good question. And I'll be honest with you, I don't know the answer to that question.
I know it. I know I can help you with that. I'm in that world a little bit, and there's several practitioners on this call. It is getting a little bit harder to fund, but it depends on the product you're going to put in. HUD right now, if you're doing a HUD finance project, there seem to be no slowdown there. I will say on the private sector, and then somebody who's on this call might want to disagree with me, but I'm starting to see that it's not slowing down, but there's, just like with the residential end of it, the level of questions are increasing, the level of requirements are increasing, where they might have been a little easier about a year ago.
Let's-
So
But
we've-
one other thing, just to comment on that too, I think, again, thinking of these trends that were in place before COVID, we do know that in some of the higher cost markets in Northern Virginia and even in Richmond, in Virginia Beach, we knew that the luxury end of the market was starting to see some rent moderation as the number of luxury buildings was maybe reaching a saturation point in some local markets. And that, I feel like, has to affect sort of the ability to put a new luxury building in the ground when the state of the market had sort of reached that point in some of these high cost markets.
So to go a little bit back on the ownership side, forbearance.
Yeah.
Big word, right? Not a lot of consistency there, right? So one lender may do very different. I have circumstances where the amount of money got added to the back end of the loan. There's circumstances I've been hearing that it's due in 3 months.
Mm-hmm.
So can you talk a little bit about that if you can, if you have any insights on how that actually is going to impact the market and more so impact individuals?
Yeah, I think you're exactly right. And I think if I remember right, I feel like I've read there's sort of 4 primary ways at which forbearance programs are structured, right? And they all have this general sense of delaying or pushing out, and whether it's wrapped into a new monthly payment or whether it's tacked on to the end of the term. The very important thing to know, and I know all of y'all on this call know this, but it is not a forgiveness program, right? It is not, you are not allowed to stop that mortgage payment or not pay that mortgage payment. It's a delay or a restructuring, as it were. And sort of to the point that we were talking about, it's very important for mortgage holders to understand what their responsibilities are in a forbearance program and to be very clear with their lenders about what they're being asked to do. Nobody wants to be surprised. But to the point I made earlier, at some point when the period comes that those payments will need to be made, the economic and the financial situations of those mortgage holders will really determine on whether the forbearance program ended up serving them well or just pushed down the road a challenge that they were going to face anyway.
So some of the practitioners that are on this call, I think that's where the foreclosure fear is coming into place, right? So, will, if it gets tacked on the back end of it, will the market change enough that you may be, God forbid, upside down or somewhere along that, what the market's prepared to pay by what you now owe if you get on it. So one of the things we counsel folks is before you do it, make sure you talk to your loan servicer and you understand exactly what you're going to about ready to get yourself into. It kind of pivots to another question that I've kind of had for you. We talked about this, I call it confidence. Right? Economics is great in our numbers, but confidence or lack thereof drives us a lot. And I know you talked about it in your presentation. Could you please revisit that a little bit and maybe talk a little bit on the impact on the market, tie COVID a little bit into it, and also the confidence on the rental side? I know that's a big question, but if you can unpack it, that would be great.
Well, I think you're absolutely right. I'm actually glad you mentioned that. We spent a lot of time talking about the economic data, but so much of the real estate industry, so much of our business is really sort of emotional and psychological and how we feel. And the numbers coming out on consumer confidence levels in August suggest that people are feeling concerned. There's similar surveys done on business confidence, and there's also concerns on the business side. When people are uncertain about what's to come, we have this innate sort of reaction that we sort of retrench and we hold back. I wouldn't be surprised if we saw that retail sales, which have been surging over the summer, start to decline in September as people decide, I feel uncertain, so I'm going to hold on to more of my money instead of spending it on my gardening and my home improvement, all my other things. I think as we see people making investment decisions, they may say, well, things are less certain than I thought they were going to be this fall. So I'm going to delay and see, since I know mortgage rates are going to be low, we're giving every indication that interest rates will be low well into 2021. I'm feeling a little uncertain now. So what might happen is business decisions, whether it's building a new rental property, whether it's purchasing a home, starting a business, folks might be saying, well, I'm going to push that off until 2021 because I'm going to still get the good rates, but I'm going to hope there's more certainty. So if I was to watch any number in the economy, the consumer confidence measure that comes out usually around the second week of the month. So in October, we'll have September's consumer confidence measures will tell us where people are thinking and what might happen in terms of those those big decisions that frankly move the economic numbers.
And we've got this little thing happen in November that might impact
Is
that a
something
little bit.
happening in November? Is there
There's something happened in November. I don't exactly know what it is. And that was my last closing question for you. And before I do that, and it's not a gotcha question, but it's something we get asked all the time, us
Really?
practitioners. You know, how is this thing that's going to happen in November impact the market? And I think that word confidence is going to play into your answer.
So I'm going to start with data, though, to answer it.
Oh, there you go.
Because I knew that I was going to get this question. And so I actually decided to look back at the 2016 election, just because it's recent and it was a change, a pretty big change. And, it wasn't a change of as big as we might see coming forward, but who knows? So it was a big change in 2016.
Lisa, can I just hold that thought for a second? I'm getting a message, because you and I could talk for hours, that we're getting close to wrap. So if you can wrap it up a little bit, then I got to close up the session. Thank you.
So you know what, Keith? The short answer is presidential election years look very different, very similar to non-presidential years in terms of sales activity.
That's right.
People expect there to be a big difference, but the data don't anticipate any major impact on the market.
And that's, thank you, because that's the data I've been digging up. There's really isn't that much. And I think the structural stuff in it is there. So we've got about one more minute to wrap up, folks. So, and thank you for reminding me, Susan, and everybody on the feed. So there's going to be a survey, an evaluation survey sent out. You can be brutal honest about my performance. I know I need help, but if you could go ahead and talk about that. But Lisa, you're a rock star. Thank you so much for that. She's going to share the slides. A little off script here. I think if anybody has any other questions for Lisa, please reach out to myself or anybody else on the team, and we'll try to get questions out there and get them answered offline. But thank you very much, everybody. Look at this. I wrapped it up right at 12 o'clock. So I don't know who ends this, but thank you, Lisa. Thank you, Tom, for sponsoring. Thank you, Carr. Hats off to the staff here at the Planning District Commission for putting up with me. So thank you, guys.
Thank you.